This is the Rocket City Retirement Show with Cris Wallace. Cris loves educating people in person and over the airwaves. Whether it's retirement planning, investing, tax, or legacy, Cris prides himself in helping protect what matters to you. This is the Rocket City Retirement Show.
Hey there, and welcome to the Rocket City Retirement Show. I'm Cris Wallace, your host, certified financial planner with WG Financial Group. And joining me today is Richard Constantine. He is also a certified financial planner at WG Financial Group. And as you guys know, again, we're absent Luann. And it looks like moving forward, we're actually going to be making some changes to the show. And, kind of what we're going for is more of a podcast feel. So you guys know that have been listening for a little while now, know that we actually upload the show to Spotify and Apple Podcast. And we thought we wanted to have a more of a podcast feel, have more of a conversational feel to the show. And then while doing so, just really start to unpack some different topics and, go through some articles that are out there and really just try to resonate with the listener a little better in a different way. So while we are going through these changes, here's what I need from you. I'd like to have some feedback from you. I'd like to know what you think about the show. And I'd also like to know if you want us to cover a specific topic, then send that in to us. You can drop it in on our Facebook page. You can email it in to us. We'll be glad to cover topics. But we're going to keep some of the show very similar. So as we, go through this first segment, we want to talk about some current events. But I do want to welcome Richard to the show. He's a little under the weather this week, so we may hear some sniffles on the air. But
I've already been told by Cris that we need to keep him to a minimum. So
keep the sniffles to a minimum.
I have the box of tissues right to my left, and we're gonna be good.
Yeah, you hit the mute button, right?
Yeah,
so
absolutely.
So welcome to the show. We want to get started. I'll start us off just by talking about something that I've noticed here, and this is something I've mentioned on the show a couple of times. But we're nearing a 4-year drawdown with the aggregate bond index, and if you think about what bonds have been and done to a portfolio over the last 4 years, it's been a pretty big drag on portfolios, specifically if you are 50-50 or maybe 60, 65, 75% bonds in retirement. It's just been a heck of a drag on a portfolio. And I think it starts to beg the question, are bonds safe? And I think we can all answer that question by saying, yes, they are safer, but are they completely safe like most, people think of bonds? Most people think of bonds as being that safe place to park money. And I think, if you look at the returns over the last 4 years with the aggregate bond index being down nearly 9%, I think you have to start looking at, other options at this point. And we talk about bonds being down -9, just conversely, the S&P is up 83% over the last 4 years. So just think again about your diversification there. And I think it starts to really, I think investors have to start looking deeper into diversification. And what I mean by that is just, outside of your traditional stock and bonds mix. So just wanted to kind of throw that out there. Again, that's something that caught my eye is that we're nearing a 4-year drawdown, which is kind of crazy to think about. It's the worst in bond history at this point.
And Cris, one of the things that we have been starting to do at WG is to alter the duration of our clients' bond portfolios, right?
Yeah, for sure. Because, the listener, just to kind of break that down for you. So what does duration mean? So when it comes to bond volatility, it's the duration that matters. So the word bond in and of itself is not a bad word. Just like when we talk about annuities on the air, the A word is not necessarily by itself a bad word. But when we talk about bond duration, think of it like a seesaw. So when interest rates go up, bond values fall at that point. And the shorter the duration, the less volatility a bond will have. So let's think about like TLT. That's the 20-year treasury, and that's a longer duration treasury or bond. And, when interest rates go up, that longer duration is going to drop a lot harder, a lot faster. And if you have a shorter duration, say you have, a 3-month to a year duration inside of a short treasury, that fall with the rising interest rates isn't going to be nearly as drastic as, say, the 20-year. And conversely, when rates fall, the 20 year is going to rise a lot faster than that shorter duration. So good point, Richard. That is something that we are monitoring and altering the duration inside of the portfolios to kind of slow down some of that volatility, if you will, because the longer that duration, the more volatile it can get for sure. So we've got a big week coming up, especially when it comes to inflation data. And actually, we record on Tuesdays, as everybody knows that's been listening for a while. And there was some key data that came out this week, Richard. The PPI data came out for sure this morning.
It did, yeah. So the PPI, that is the Producer Price Index. So it's slightly different than the CPI. The CPI is the Consumer Price Index, but the PPI measures what businesses are charging. And so although the CPI and the PPI, you can have pretty accurate guesses on how they're going to react to each other. But at the end of the day, they are different. So the PPI came out at 0.5% in increase from the month prior. So what that means is goods on the selling side of it are becoming, they're selling them for more than what they were back in April.
Yeah, and if you look back over the last 1 year, it's really the highest it's been in about a year. So we've seen a little bit of a reversal, in terms of PPI. So you see a little bit of an upward trend right there. And then I think Powell he actually came out and said some things. Today is a day that Powell speaks. And he said inflation has been, and I quote this, inflation has been higher than thought. And, he expects rates to hold steady. So this is definitely in the camp of higher for longer. And to the listener out there, what does higher for longer mean? It means that they expect to hold the federal funds rate at the higher rate for quite a while. Now, one of the thoughts that, that ran across my mind as they were talking or saying that, or, he was mentioning that rates are, expected to hold steady, was the home buyer that's out there today. People looking to buy a home, and they're banking on rates going down in the nearer future. So let's say we're buying a home today, and there's been talk of rate cuts in the fall. Well, what if that doesn't happen? And that is kind of my message to the listener today listening or buying a home is, hey, if you're buying a home, I don't know if I would be banking on a refinance in 6 months or 9 months. I don't know what your thoughts are on that, Richard, but it's looking more and more risky.
Oh, yeah, without a doubt. Someone that I went to school with, he currently works as a mortgage loan officer through a large regional bank. And, I got talking to him because, Chris, as you know, me and my fiance are currently renting. There are some benefits to home ownership, that we want to buy a home eventually, but in the current environment, we just can't stomach paying that interest rate. But I was talking to my friend who's a loan officer or a loan originator, and he said that the rate at which people are coming in and purchasing variable rate, like ARMs, for loans has gone absolutely through the roof. And well, it is true that, they are getting a discount on their rate terms now compared to a standard 30-year fixed mortgage. If rates don't decrease like people are expecting them to, and the people that are hoping they are going to when you purchase, or I guess you finance through an ARM, there's going to be a lot of people with mortgages that they can't afford.
Yeah, no doubt. I think there's a lot of risk there. And I think there's a lot of people, like I said, banking on rates dropping. And to be honest, I think I was in that camp too. When we go back to the tail end of last year, I can honestly say that, hey, inflation is trending down, and we've got a nice, solid trend moving downward. The expectation is rate cuts this year. The market thought the same thing. And now we've seen that complete reversal. So again, it's just something that I thought about today. I was like, oh my gosh, people are, because if you look at home purchases, that's ticking up a little bit, because it is the time when people are buying. But I think there's also buying in anticipation of rates dropping as well.
Oh, well, I mean, I've played that game too. I've gone on the online mortgage calculators, and you were like, okay, Richard, you can bite off more than you probably should chew, for a short period of time. But if rates don't go down and you don't have the option to refinance, like, you're going to be stuck with paying this bill, and it's a mortgage, right? So it's not quite a bill, but I mean, you're going to be stuck paying it. And, that just wasn't a route that I wanted to go down at this time. But, I mean, that's the game that most people are playing right now.
Yeah. And I think if you couple that with property taxes going up too, so you've got this higher rate that we're talking about, and you're stuck with that. And then you've also got property taxes that are going up at the same time, and not to mention insurance. So you've got higher rate, higher property taxes, higher insurance costs, because we all know insurance costs have gone up. Then all of a sudden now what you thought was your house payment is now $100 more per month because of those other two factors. So again, I just think it's something that you have to consider that may not, don't bank on it is what I'm saying. And I'm not sure I would bank on it. And it sounds like, you've decided, Richard, yourself, that you're like, hey, you know what? I'll just let some of the dust settle for a little bit before I make a commitment on actually buying a home.
Oh yeah. We agreed to a 2-year lease extension back in December at our current apartment complex. Cause they were offering, certain discounts, et cetera, for signing a longer lease. Mm-hmm. And, I mean, looking at it, that was actually like the week prior to when, or I mean, at that period, we thought there were going to be 6 rate cuts in 2024. Mm-hmm. And it was almost like, okay, do we do this, or do we, just do it 1 year and then, buy a house, or do we just go ahead and buy a house now? Right. But after looking back on it, I mean, it was a great decision not to, stick yourself with, an 8% mortgage essentially.
Yeah. Yeah, no doubt. So that's kind of where things. Oh, sorry. Go ahead,
Chris. But one more thing, one thing I'm kind of shocked about is kind of how wrong the Fed was back in October when they announced that, hey, there's going to be 6 rate cuts. I almost feel that is like, I don't know. My view of the Fed is that, they are reporting facts, and, they are reporting what is going to happen. It shouldn't be so much speculation in nature. What are your kind of thoughts on the kind of the big reversal that we've seen between 6 rate cuts to, maybe 3, and now at present day, maybe 1?
Well, I've raised 3 kids, and you learn early on as a parent, don't promise something, right? And so when they spoke, it was like, if you've ever seen the movie Dumb and Dumber, and so it's not a great movie, by the way, if you haven't seen it, don't waste your time with it. But I saw it, and there's a scene where Jim Carrey says, "So you're telling me there's a chance?" And that's what the investors thought and the market thought. And it starts pricing in these cuts, and we saw the 10-year yield drop, and we saw the equities take off. And I think, and I've often said this, and you've heard me say it before, we have political glasses and we have 401k glasses. Then we tend to look at our investments with our political glasses. And at the end of the day, the glasses that we need to have on are that most people, or I say most investors have on, is the Jerome Powell glasses, because that's what everybody should be looking at. And I think when they spoke before right at the tail end of the year, a lot of people took them at their word. This is what's probably going to happen. And now we've seen this stickiness, and we're probably not going to see that drop like a lot of people thought, back at the end of the year. So I'm not a fan of it. I wish that they would, I guess to answer your question, I think they should really watch what they say, because, when you're in a relationship, husband, wife, boyfriend, girlfriend, just maybe your friends, words matter. And they do, because what happens after Jerome Powell speaks? Everybody out there reads the transcripts, and they go over every little word he says, and they try to, bring meaning to what he says, whether it was, hawkish or dovish or whatever. So words matter. And I think that in some cases, I wish they just wouldn't say anything. I wish they would just present the data,
Yeah. Well, and I feel like, and this could just be me, but I feel like, in the past 2 years, we've seen Powell so much more on news and whatnot than back when interest rates were, back in the zero interest rate policy that we had for a long period of time. And granted, I mean, words should carry the same weight regardless of if it's now or in a different policy period, in my opinion, for a high ranking political officer such as, him.
Yeah, well, I think we're seeing a lot more of him because we stayed on zero interest rate policy for so long that that's what everybody wants again. I mean, it's kind of like sugar. I mean, sugar is very addictive, and I love my dark chocolate, and Richard, we have a lot of those candies at the office. I partake in a lot of those, but that's what investors want. They want to know when are we going back to lower interest rate environment? And I just don't know that. Well, first of all, I know we're not headed back towards a zero interest rate policy for at least for the foreseeable future. I would wonder if they'll ever let that happen again unless something catastrophic happens. So I think we are going to see a higher federal funds rate for a longer period of time. But even when they do cut, I think when people go to purchase houses in 1, 2, or 3 or 4 years down the road, I still think that when we're looking at like mortgage rates, I don't see those getting back down into the low threes or the high twos. I think that, if you can get a 5% interest rate, 2 or 3 years from now, that's probably what's going to be the new norm for quite a while. I just don't see that, being really low. So anyway, I don't want to drag this on too much because I want to get back to the article that we started covering last week. At the very end of the show, I said, hey, we got like 4 minutes, and I tried to run through a couple of topics. And again, this article, just as a reminder, was sent to me by a listener who says he's our biggest fan. And so it was kind of a nice email that he sent, and then sent over this article and said, hey, great radio material. So this is an article on Newsbreak, and it's 12 signs that you're doing well financially over the age of 60. So the very first one, we kind of covered it last week, is that your home is paid off. And Richard, you and I talked about that. It's not the end of the world if your home is not paid off. But from a stress standpoint, we can say that, it does alleviate stress. But we've seen people, I mean, you and I've sat in meetings with individuals and families who they have enough income to be able to pay for the house, even though, make a mortgage payment while they're in retirement.
Right. And it's, if they have enough cash to pay for the mortgage up front, then we can modify their plan to where they're going to have enough income to pay off the mortgage, on that on the current scheduled plan. But the thing that really sticks with people is the mental side of it. Of, oh, I am debt free. I do not have to make another payment. I don't know anybody anything. And we found that for most clients, they enjoy that extra peace of mind.
Yeah, for sure. And I think the drum has been banged by people that are famous on the radio, nationally syndicated, that you always want to pay your mortgage off. And, when you hear something multiple times, you start to think, well, yeah, that is the way I'm supposed to do it. That's the way so-and-so said I'm supposed to do it. But we've seen it where people will actually harm themselves. And I think you shared a story last week where someone wanted to pull out of an IRA just to pay the house off, just to have it paid for. And you had to work with them on a more tax efficient way to do that. So again, just kind of, it doesn't, having your home paid off north of 60, that's a great thing. It does alleviate a lot of stress, and it'll help you in your transition to retirement. Number 2 on the list is you've already completed any needed renovations. So small renovations, not a big deal, but we do encourage clients in the latter part of their pre-retiree years to go ahead and make a big ticket item list of things that you're going to need to do. So HVAC replacement, maybe there's a roof replacement, or maybe it's a landscaping project, or replace a driveway that's cracking that you've got at your house or something like that. Those bigger ticket items we think are really important to take care of. Number 3 on the list is you have money for leisure time. Now, this is really important as you transition into retirement. Richard, we sat in a meeting yesterday, and remember the wife said that she was schizophrenic right now.
Right. Right.
One day she wanted to retire. The next day she didn't. And the next day another personality came out like we can't afford to buy this or that. So I think, having excess funds and income to enjoy those leisurely times in retirement, that's important. That's an important part of the lifestyle in retirement.
Yeah, well, that, Chris. And then, yesterday I was on the phone with one of our clients, and, so she pulled the retirement trigger about a month and a half ago now. And, I just called her to ask like how things were going. And if they were doing all right. And the way we built their plan out was for them to pull more money out each month than they're currently pulling out. And I asked them, hey, is your income sufficient, et cetera, et cetera. And she was like, well, it's taking some time to get, used to splitting the Social Security, putting it all into our joint account versus me keeping a portion of it and putting blah, blah, blah.
Right.
And I was like, well, the way we built your plan out was to do more. But at this time, they weren't comfortable enough to do that. And so I think it's important for our clients and other, pre-retirees and people who are entering the beginning stages of retirement is to understand that, you've worked all of your life to build up this nest egg, and it is okay to spend the money that you have saved.
Yeah. It's a habit that we develop when we're working, and it's to save, right? We save, and then we pay our bills, go to work, and save some more. And that's what we've done for 25, 30, 40 years. And in retirement, like I've said on many occasions, it's kind of doing that in reverse now. Doing retirement is actually you're taking out of those accounts. And that's why you saved. And, being comfortable with that, there's a transition period. And that's what I was explaining to this lady that I was meeting with yesterday with her and her husband. The meeting that we were in together, Richard, was this is a transitional period that you're going to go through. It's going to take, at least a year for you to feel comfortable with how life feels without getting up every day, going to work, having the work paycheck, the faucet of income, as we like to call it. Transitioning away from that security it takes time. And when the anxiety hits, I think it's very important for you to do all that you can to eliminate the stressor items. So for this particular individual, one of the items was, when do I retire? Well, during our meeting process, we were able to convince her that she could retire. So boom, we can check off one box. I know I can retire. That's the next thing. But here's the thing with this family. They're not only retiring, they are being told that they have to leave their current rental property because the landlord wants to sell the property. So they have to get out of the property sometime by early fall. And then they also have to find a place. So here we are entering retirement where we're turning off the security of income from our job. And then you're thinking, well, do I have enough? Do I have enough to last all the way through retirement? And now this family is going to have to find a place to live all at the same time. So this is a major ball of stress for them. And I do not envy their situation whatsoever. So again, just making time, making sure that you have enough saved for those leisure times in retirement is really, really important. Next item on the list was number 4, comfortable with your Social Security decision. Now, I've been in the industry a long time. We have very specific reasons why we have people wait on Social Security. We have claiming strategies for certain families, depends on their situation. But I've heard time and time again from a lot of people that decided to claim early on Social Security, and they're not comfortable with it, right? So they come in, I meet with them, and then all of a sudden they were like, man, I wish I would have heard your show a few years ago, or I wish I'd have met you 10 years ago. But making sure, if you're listening today, you want to make sure that you're really comfortable with your Social Security decision. You want to look at things other than the break even. And a couple of things that we like to talk about is how Social Security is more, tax friendly. We also think that it's, a spousal death benefit in a sense, because a husband and wife, if the wife is the higher income earner and she passes away, the higher income is, what the husband keeps. He'll lose his, but keep hers if it's higher. So the higher income earner in a family situation is really, really important. So again, being comfortable with that. Number 5 on the list is your 401k. All right. So I know, Richard, I know you've heard this a lot, and but how do I take withdrawals? How do I turn my 401k? How do I turn my nest egg into income? And one of the key things north of age 60 is making sure that your 401k, i.e. your retirement savings, is actually working for you.
Oh yeah. I mean, one of the biggest things that that we want to remind our clients is that, the goal of your money is to make it work for you. Almost everyone who's in retirement is almost a business owner. They are now employing their savings to work for them to get them through their retirement, and if they desire to pass on to the next generation or to pass on to another institution such as a church or other charity.
Yeah. And this is, if you're listening to the show and you're on the younger side, which we have a lot of younger listeners, this is why it's really important that you learn to boss your money now. Because if you don't learn to boss your money now, it will boss you the rest of your life, and it will prohibit you from being able to do the things that you want to do. You'll always work for money, and you'll never be able to get to the end of the road of retirement if you're not saving adequately. And that means, bossing your money early on in life and learning to be the boss of it and not having your money be the boss of you. Number 6 on the list was north of 60, doing well. You can enjoy hobbies, and that's a big thing. Again, you've worked so hard your entire life to save money. You need to be in a position where you can actually enjoy the hobbies. These are the things that are going to help you transition away from that rat race that you're used to. Your mind is used to going to work and putting up with the stressors. And now you need to be in a position where, you can start to disengage from work. And when you pull the retirement plug, having things to do and hobbies are really important as you start to envision your retirement. Number 7 on the list was catch-up contributions. If you're going to be 50 this year, you can start making catch-up contributions to IRAs, 401ks. It's important to make those catch-up contributions, especially if you're actually behind on retirement savings. Number 8 is portfolio. Your portfolio isn't in risky investments. Now, again, I think there's arguments to both sides here. Richard, you and I have built a lot of financial plans. We work with a lot of people at WG Financial Group. Sometimes you can be a little more risky, but then there are people, as we've seen, who don't need to be as risky, but they're willing to take a little bit more risk, but the plan won't allow them. So that's where we get into risk tolerance and risk capacity. And again, some people don't need to be quite as risky.
Right. Well, yeah, especially if they're right at their retirement doorstep. Definitely not. But for the younger listeners out there, we don't want you to think that that risk equals bad. Different risk equals different things at different stages in life.
Mm-hmm. Yeah, for sure. Number 9 on the list was having an estate plan. So making sure you have your legal documents in place. That's something we see a lot of people come into the office. We don't do legal documents at the office, but we do ask if you have them. And if you don't, we refer you to that estate attorney. Having all your debt paid off in retirement. Again, another really, really good thing. Having a retirement plan as a self-employed, as self-employed individuals out there today listening to the show, it's important that you're contributing to the right financial or the right retirement plan. I almost said right retirement process, like our process, but having that retirement plan we think is important for the self-employed individual out there. And then one of the last things here is talking to a financial advisor. Obviously, we carry a little bit of bias there, but I can tell you from my own personal situation that as I've gotten into the industry and I've studied this and met with, literally hundreds of people at this time, then it's good that I'm able to learn, and I have been able to really enhance my own situation being in the industry, knowing where I should be saving money, how I should be saving money, understanding the taxation, and just trying to look at things. So those things
Chris, sorry to cut you off, but it goes back to that article you and I discussed last week about over 70% of millionaires work with a financial advisor versus 37% of the general population.
Right. I mean, that kind of speaks volumes in a sense. I think I reached a point where, I wanted to get in the industry, and the industry taught me a lot of things. I'm still not perfect by no means, and I try to learn something, every single week. So we're at a point where I just want to remind you, if you are listening to the show today, this is WG Financial Group. My name's Cris Wallace, certified financial planner. With me today is Richard Constantine, a certified financial planner at WG Financial Group as well. We're happy that you're here. If you'd like to give us a call and set up what we call a discovery session, you can do that by calling 256-937-2010. Our number is 937-2010. If you want to go to the website, wgfinancialgroup.com, you can also request an appointment there. We would be happy to sit down and go over your situation. We are primarily working with pre-retirees and retirees. That is our core market. But if you're a younger individual or a younger family out there and need help as well, we'd be happy to talk to you as well. Again, our number is 256-937-2010. And again, this is Cris Wallace, Certified Financial Planner with WG Financial Group.
Want to feel confident in your financial future? Let Cris Wallace from WG Financial be your guide. Take the first step today by visiting WGFinancialGroup.com.
Quarters, just 25 cents. That's hardly anything, right? But Cris Wallace and his team at WG Financial see quarters a little differently. A quarter is a lot when it's a quarter of your retirement savings. Now, do you want to pay 25% or more in taxes during your retirement? Well, Cris can create a plan to help address that. Now, if the only time you think about taxes is when you file them, you don't have a tax strategy. But it's not too late to get one with the help from Cris Wallace. So act now to make sure you're not paying a quarter, dime, or even a penny more than you should. Call Cris Wallace and his team at WG Financial at 256-937-2010 to schedule your personalized tax strategy session. A quarter saved is a quarter earned. Call 256-937-2010 now. That's 256-937-2010. Investment advisory services made available through AE Wealth Management, LLC, a registered investment advisor. Firm may not give tax advice.
Don't panic in uncertain market times. Let Cris Wallace be your trusted guide. Call Cris Wallace today at 256-937-2010 for expert advice and support. That's 256-937-2010.
All right, Richard, I want to transition into another topic here, and this would probably more fall under, I would say, like rules of thumb, right? So many, as you get to retirement, there's been lots of articles written on rules of thumb and whatnot. There's been studies done. One of the big ones that a lot of people know about is the 4% rule. So that's kind of where I want to take the rest of this conversation, is kind of centered around the 4% rule. Let's talk about pros and cons. How does it work? I think there's been a lot of misconceptions around it as well. So I want to talk about that. So Richard, if you can, I just want to, if you can just kind of start us off on, I just kind of describe what the 4% rule is.
Yeah. So the 4% rule is generally regarded as a safe withdrawal strategy for an individual throughout retirement. The goal is that you take 4% of your starting portfolio balance in year one, and then increase your withdrawals so let's say you had $1 million in retirement at year one, take 4%, which is $40,000. You take $40,000 in year one, and then each year you increase the $40,000 withdrawal by essentially how much inflation increase. So that way you are still maintaining the same purchasing power, but you're not increasing your withdrawals significantly.
Right. And I think when we look at the 4% rule, and I think where you have to be careful with that is if you're doing it, the true 4% rule, and you're taking that, in your case, like you mentioned, $40,000 adjusted for inflation, in the first year it is 4%. But let's say the portfolio, just for argument's sake, cuts in half. And now instead of, 4%, we're at a much higher rate. And I think that's where, when you hear on the radio, we've talked about it. I know a lot of people, there's been a lot of articles written on it. That's where the sequence of return risk comes in, because now your portfolio is significantly down, and yet you're steady pulling, more money from the portfolio. So I think the 4% rule does come with some drawbacks, and that being one of them. I think the 4% rule also can require some flexibility, but this was first kind of brought about back in let's say early 1990s by a gentleman named Bill Bengen. He was really the one that developed the rule of thumb, back in 1994. And basically, as Richard, as you alluded to, it's supposedly supposed to be a safe withdrawal rate for most retirees, but you have to think about when this study was ran, right? So, you think about 1990s, you think about your equity returns in the 1990s, think about where bond returns were in the 1990s.
Well, I think that's the big one. It's the bond side, right? Because this study was done on a 50% stock and a 50% bond portfolio.
Mm-hmm. Right. No, 100%. And I think if you look at, there have been multiple studies done since that study. And I think what we've seen, with the 4% rule is it became, in some cases, less than the 4% rule, right? I think Morningstar came out with a study. They've done multiple studies, to be fair. And depending on when the study was ran, it determines whether or not the 4% rule actually works.
That is correct. And one of the things that, personally, I don't really agree with is that you necessarily use all historical data. I mean, history, typically rhymes with the future. But when a family comes to us and we're designing a withdrawal plan, we can't anticipate, long-term care events, when that's going to happen. If a client doesn't have a long-term care plan in place, we're going to have to withdraw a lot more than 4% during those periods. And so you don't want to max out your withdrawals and bind you in a situation. I mean, one of the things that I believe is retirement equals flexibility and freedom.
No, it does. I mean, you have to. I think when we like to say it, when you give up the faucet or turn off the faucet of income, right then and there, you're giving up some of that security that you had in income. And as we've often said on the show, there is no retirement without income. So when you turn off that faucet, you have to have a sustainable way to generate income. I think it also needs to be verified by math, and it needs to be pretty secure. And there are plenty of studies out there that have shown that the more guaranteed income that comes into the household, the more sustainable the financial plan is, because you're not having to rely on the portfolio to do, as much work. And to your point, Richard, I think when we look at returns, I think you said it really well. History doesn't always repeat itself, but it often rhymes. So we can expect, assuming the U.S. continues to grow and innovate and companies continue to flourish. And we talked about last week how, certain companies lead the S&P, and that's been the case throughout history, is the innovators kind of rise to the top. The companies that are, essentially changing the world in a sense are the ones kind of leading the charge. And we want that is innovation, that's growth in the economy. But we can assume that rates, or returns rather, for equities are always going to be, over a long period of time, they're going to be higher than what bonds are going to be. Now, I think where we have to be cautious is, assuming, because we hear on other shows, or I've heard on other shows, and I won't name names, 12% mutual fund returns, right? I think, when you're retiring, and if you look at like the S&P returns over a 100-year time frame, you can say that the S&P is going to return somewhere around 9 to 10%. I think that's a fairly accurate statement there. If you adjust it for inflation, it's going to be a little lower than that. But I think you can assume that those rates will be higher over 100 years. I think the tricky part for the retiree today is you don't know where within those 100 years you're going to retire. And if you look at, and I've said this before on the show, like if you look at the returns from like January of 2000 through the summer of 2020, the S&P was only like a 6.2% rate of return. So, in thinking about that, okay, that's a 20-year time frame. So yes, I kind of cherry picked that time frame, but I cherry picked the time frame to kind of make a point here that 20 years is probably going to be 2/3 or better of most people's retirement. So your retirement,
Chris, that 6% return is also compounding on itself. If you're pulling funds out of the portfolio during that period as well, you're not growing at 6% from a value standpoint.
Correct. The growth, the number will still be the same, right? But to your point, the value of the portfolio is likely going to be a lot less. And so I think when one of the things that we've seen a lot that I know that I've run into is that when spreadsheets are, brought into the office, that those types of assumptions are made, and sometimes they're aggressive assumptions. And I think when you're going into retirement, personally, I would prefer to estimate on the lower side. And I think when we're building plans at the office, we are personally making some lower assumptions. We're making lower return assumptions. We are looking at cost of living adjustments, and should we do them lower in certain areas? And if we do, why are we doing that? And, kind of working with our clientele to kind of explain to them, we are purposefully being a little more cautious here, because I think, anytime I sit down with a client, Richard, I know you're probably the same way. We when we give the green light, we want to be confident that the green light is the green light and not the yellow light. And I think that's really important to a lot of the people that we serve.
Oh, absolutely. And, the reason why that's so important is, well, one, Chris, I mean, I can't even imagine like what it would be like to receive a call from a client and say, hey, we are, or really be another way around. I would have to call a client and say, hey, you guys are going to run out of money. So to your first point, I mean, we want to make sure that your plan is secure and we don't have to make that call. The second point is, most clients and just retirees in general, they live off a nominal figure. Let's say that number is $10,000 a month. Well, they expect that $10,000 a month to live off of, regardless of what the market is doing. So it doesn't matter if the market's up 30% or the market's down 30%. They still want that $10,000 a month. And, that's great that, that's great that they have those things that they're doing that cost $10,000 a month, if we're, being completely honest. But the drawback of using a fixed 4% rate of withdrawal while still needing a specific nominal amount, it can sometimes lead to not great situations.
Yeah. And I think the articles that were, when we talk about the 4% rule, I can remember, because I've been in the industry a little while, but back in 2013, Morningstar released an article where it was David Blanchett, I believe it was Michael Finca, and maybe Wade Fowle. They did a study where they were suggesting closer to a 3% withdrawal rate versus a 4% withdrawal rate. So I think as the retiree, when you're getting ready to retire, I think there's several factors that you have to think about as we kind of talk about this. So number one, you have to think, where am I retiring at? Am I retiring at the top of a cycle, at the bottom of a cycle? I mean, to be honest, ideally, it would have been nice to retire sometime, or maybe around 2013, right? So at that point, you went through the 08 crash, and probably for most people by 2013, if you left your portfolio alone or made some adjustments, probably by 2013, your portfolio was back. Well, then since 2013, we've seen a pretty massive uptick in the market. Actually, you've seen a massive uptick since 2009. But again, assuming that, say, you retired in 2013, that would kind of be ideal. We were on a quantitative easing, QE1, QE2, QE infinity, if you remember, that's what it was called. And, your portfolio at that time likely grew. So I think, when you're thinking about retiring, I believe you have to go into it with a mindset of what if. And I think in some senses, you have to think about it like the what if retirement. What if I retire and I see a recession in the first year that I retire? Can I afford to take, a certain percentage loss? And I think you have to think about that. You also have to think about it from a mental standpoint, right? So think about turning off the faucet of income, knowing I'm probably not going to go back to work. I'm now, say, 63, 64 years old. And, mentally out there, you're like, hey, nobody's going to want to hire a 63 or 64-year-old. So there's a lot of mental stress that comes with just retiring alone, just retiring in it of itself, but then couple that with a loss. And so can my portfolio withstand it, but also can my mental state withstand it? And I think that's really important. So you have to think about that. I think today you have to think about, well, where are interest rates? And, unfortunately, for the people that are on fixed income today, that would be the retiree. you are retiring and things are much more expensive today. And while inflation is likely to come down in the future with, additional monetary pressures, I'm sure, what you have to realize is there's a permanent elevation in price when it comes that's associated with inflation. So as I've said before on the show, the $5 hamburger is now say $10 or maybe $12. Well, that hamburger is not going to go back to $5. That's the permanent elevation in price. So you are retiring into a time frame where the cost of goods has gone up tremendously. So now your cost, through your retirement is now permanently elevated. And I think that's something that has to be considered today as you start to build out your plan.
Well, yeah, that, Chris, but also to avoid just being the doomy gloomy person, if the market performs well, clients can take out more than 4% of their initial retiring balance. So I think what it really boils down to is, being able to be flexible as times change.
Yeah. Again, goes back to the F word there, being flexible. It's what you said earlier. And I think you have to be. And I think when you retire, the importance of having a plan in place that is, you kind of have your roadmap, but you also know, like when you and I have gone on, you've gone on trips before, I've gone on trips, you're on your way and then there's construction or something and you have to take a little bit of a detour. Well, I think the financial plan that you build is your general roadmap. You know where you're trying to get to, point A to point B being end of life without running out of money. And I think during that journey, there does require some flexibility. So there may need to be some slight changes to the portfolio, slight changes to the plan, because things in the economy change. We know that we were on a zero interest rate policy for a really long time, and now for the last few years we've had an elevated fund rate. And for people that got used to that zero interest rate policy, this feels really uncomfortable. But this may be the new norm, and I think that if you're retired today, you have to have that flexibility, like you said, Richard. There was another article, I think this is the one you kind of dug up. It was from Forbes back in February of 2023, and it says, I think it goes over different numbers in terms of how the 4% rule works, which is what we're talking about today. But then it also shows what happens with elevated withdrawal rates for an extended period of time. And I'd like for you if you can, just kind of walk through what you kind of found there.
Yeah. So, Forbes ran a similar study as Morningstar did, and it compared taking a 50-50 portfolio, so 50% in the S&P 500 and 50% in intermediate term treasuries. They ran a portfolio for 50 years, and they started a new portfolio each year. So let's say it started in 1950. Well, it ran that portfolio till 2000. Then it started another one in 1951, et cetera, et cetera. So they compared it for the 3%, 4%, 5%, and 6% withdrawal rate. So every single portfolio lasted with a 3% withdrawal rate.
Mm-hmm.
With a 4% withdrawal rate, 10 out of the 50 years, the portfolio did not make it that full 50 years. At a 5% withdrawal rate, over half of the portfolios did not make it the full 50 years. And at a 6% withdrawal rate, 43 out of the 50, so 86% of the portfolios did not make it the full 50 years.
So that, as you go through this, so basically what I understood, in what you were talking about there is the 4% rule kind of works. 3% for sure. 4% kind of works. 5%, you're starting to stress. Half of them are going to fail. At 6%, nearly, the majority fail at that point. And there are people running around on the airwaves today mentioning an 8% withdrawal rate.
Right.
And here are studies ran by, people that understand math and understand, investment volatility and withdrawal rates. And basically at 6%, that's the trouble point, big time, 6%. 5% is, here's the deal. I wouldn't get on an airplane if there was a 50% chance that the airplane makes it to the destination, right? I mean, statistically, when I get on an airplane today, and I don't know exactly what the statistic is, but I assume it's 99% or higher, I'm okay with that. I fly. I don't like to fly. It's not my first method of travel, but I will fly because it's a lot easier. But I can promise you, if I got on that airplane and I sat down and the pilot came on the intercom and he says, "Hey, I just want to remind everybody that we're about to take off. And just so you know, there's only a 50% chance that we're going to make it there." I can promise you, you're going to see me on Twitter, on Facebook, with somebody on somebody's cell phone filming me freaking out to get off the airplane, because that's exactly what I would be doing. So, if we're going into retirement and in our minds, we think that we're going to comfortably withdraw 5% from our portfolio, and knowing that studies show that 50% of the time it fails, there ain't no way. Why would we even do that?
Exactly. And even at the 4%, Chris, which is the harped on, right? This is safe.
Yeah.
Still 20% of the studies failed.
Yeah.
But I promise you, if you were a little bit flexible in that period, it would have been successful.
For sure. Yeah, for sure. And I think, if I'm being really transparent here, which we always are, obviously, the number one fear for today's retiree, Richard, as you know, as it's all over the internet, is number one fear is running out of money. That is bar none the number one fear. But in reality, I truly believe that those who develop a plan, they'll have a much chance at they'll have a much better chance at success by building a plan alone. And if you're, go ahead, sorry, Richard.
Oh, well, Chris, like to your point about, being on a trip, right? And you'll be flexible and there might be construction, et cetera. Well, the way I view it is, if you're trying to do it by yourself, it's essentially operating off of the old atlases that everyone had in their car. You're going off a map of an area you've never been to and hoping you get to the end goal, versus having someone in your corner that you can talk to, such as a CFP or another financial advisor. It's essentially like using Siri and Apple Maps now, and it's going to get you to your target a lot quicker.
Yeah, just don't call me Siri in the office. That's all I got to say.
I don't know. With all of your the voice to text that you do in the office, I might call you that.
Oh man, you don't want to read some of those messages. Oh my gosh, the way that Siri translates my accent sometimes in the words is just it's embarrassing. Yeah, it's absolutely embarrassing. I have to proofread and then I still miss things because that's just how it goes these days. But excellent point on using the old atlas, because I think that is the tendency for some of us out there is, okay, well, I've run my spreadsheets based on this information. The reality and the truth of the matter is we don't know what's going to happen in the future. So our methodology is to plan, for more of a worst case scenario. I always like to say that there's no way to truly plan for the worst case scenario. I don't believe that there's a way to plan for the worst case scenario, but I do believe that you can build your plan that's on the more conservative side of things, meaning return wise, withdrawal rate wise. And I think if you do that does increase your chances of success. So the other thing I wanted to mention, that when you're building out your financial plan and the number one fear is running out of money, I believe if you're working in a team atmosphere with, a financial advisor, I always think people need an estate attorney and a CPA as well. But, working with those individuals, you basically have them on your team to help your family's chances of success. And I think that even though the number one fear of running out of money is the number one fear, I also believe that if you're working with that team and you're monitoring those accounts and you need to make some adjustments, or you need to have someone tell you, hey, that's not a good idea, that increases your chance of making it all the way through retirement without running out of money. So I'm a firm believer that even though that's the number one fear, if you see your account dropping at a rapid rate, that's probably going to help encourage you to kind of curb some spending. Like, in other words, I don't think you're going to be spending as much because you've seen your account balance go down by, say, 25 or 30%. I mean, if you look at, put that on a spreadsheet and you start watching your balance drop, that's going to make you slow down your spending just, in general. So I'm a firm believer, even though that's the number one fear, I don't believe most people will run out of money because you're going to know that you can't spend at that same rate through retirement.
No, I agree. And, Chris, one of the things that I thought was pretty interesting, it was both Forbes and Morningstar, they alluded to this, is that they found that holding too few of stocks did more harm than holding too many stocks. And essentially what that means is, they found that being at least 50% in stocks or other equity positions, that was essentially the minimum amount that they viewed as safe.
Yeah, I've often said on the show, Richard, before you started joining the show, there is a point where I firmly believe this, and this has the data that backs it up, is I actually believe that you can be too conservative in a financial plan. And I think being too aggressive is also not a good thing as well for most people. I think there's, varying degrees of, situations out there. In other words, if you have a ton of guaranteed income, maybe a military pension, a FERS pension, et cetera, I think at that point, and you've got everything covered, you're probably not going to spend all of your assets at that point. So you could technically be a little bit more aggressive because your time horizon could be a little bit longer. But for the average retiree out there, I believe there's a fine line of being too conservative, but then also being too aggressive. And I think at the end of the day, I think making sure that you have a financial plan, a well-defined way in which you're going to withdraw income that's stable, potentially guaranteed. That way, that things are covered throughout your retirement from an income perspective. Because remember, if you can't generate income, then you must hang on to the job because that is providing that income today. But having that plan, building that plan, defining that way of drawing income, what that does for you is that does increase the confidence in you. Because remember, as I've said, multiple times during this show, is that, as you transition into retirement, there is going to be a lot of stress knowing that, I don't have the income, anymore. And then you start to wonder, do I have enough? Is it going to last? And oh my gosh, what if I pass away? Is my spouse going to be okay? So all of those things start to eat at you when you retire, because we know when we're going to retire. We just don't know when we're going to retire away from this earth. And that is where the years in the industry that I have, having a certified financial planner designation, the training, the education, Richard having that as well. And then all of my staff members that are going to sit with clients in the future must also be obtaining or in the process of obtaining that designation, because we want families to know, investors to know that come in to see us, that they are sitting down with a CFP. So if you're nearing retirement and you're looking for, someone to help you get through the rest of your pre-retirement years and all the way through retirement, that's what we do at the office every day. We enjoy sitting down with families and really mapping out a vision for them so that they can have the confidence to walk into their retirement knowing that they have somebody walking side by side with them every step of the way. So that's what we do at the office. If you want to set up a discovery session, you can give us a call at 256-937-2010. Again, the number is 256-937-2010. Hope everybody has enjoyed the episode. I hope everybody has an awesome and blessed week. And remember to serve every person in every situation with a servant heart.
A Roth conversion is a taxable event and may have several tax-related consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA.
Investment advisory products and services made available through AE Wealth Management, LLC, a registered investment advisor. Insurance products are offered through the insurance business WG Insurance Services. WG Financial Group is an investment advisory practice that offers products and services through AE Wealth Management, LLC, a registered investment advisor. AEWM does not offer insurance products. Insurance products offered by WG Insurance Services are not subject to investment advisory requirements. AEWM and WG Insurance Services are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. WG Financial Group is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by WG Financial Group. This radio show is a paid placement.